Good day, Team GCI. I'm Brad Alexander, and in today's GCI Market Outlook, let's take a look at Forex trading on the NASDAQ, Euro-Yen, Dollar CAD, and Euro-Dollar. Just a reminder that these videos are intended as educational. We are only observing current market conditions, and these are not to be considered as trading advice. Looking at US dollar pairs, we see short-term weakness after a period of strength. The markets may be a bit slow today as we are all waiting for tomorrow's delayed non-farm payrolls, which always moves the market. Also this week we have US retail sales, US unemployment claims, and CPI, so the combination of all this will give the Fed some idea of where the economy is headed, especially in terms of the labor force and inflation. US dollar weakness looks like this on the dollar-yen chart for most of the US major pairs. However, JPY is stronger right after the elections as confidence returns to Japan. However, many analysts feel that this strength is short-lived, so we will be watching pairs like Euro-Yen to see if price action bounces back off this lower trend line. Dollar-Yen doesn't have a clear upward trend channel like the other pairs, but we see a very oversold stochastic oscillator on both the 1-hour and the 4-hour charts. We talked about one index lagging behind the others, and we see it again with the NASDAQ well behind the S&P 500, the Dow Jones Industrial Average, and the Russell 2000. There are many reasons for this, but if investors feel risk on in the markets anytime soon, we may see a resurgence. Also, we have GDP from the UK and CPI from Switzerland, so we will find a few charts showing bull and bear runs on both currencies. If the news moves price action against the trend, we may have an opportunity to trade with the trend. We've been looking at setting up and using simple moving averages on cTrader, so now let's look at exponential moving averages. To set one up, click on the indicators icon and, under Trend, select Exponential Moving Average. Set the period you want, the color, and the line thickness. An EMA is essentially the same as an SMA, but the EMA gives more weight to recent price change, so it reacts faster. Many traders prefer EMAs as they provide a smoother curve, as we can see by comparing these moving average crosses, SMAs versus EMAs. As with any technical indicator, find what works for you and backtest, backtest, and backtest. That's all for now. CFDs and FX are leveraged products and your capital may be at risk.